So our next stop in the investigation of the Capstone Courier is to look at some of the financial information. So there are two main types of financing sources for businesses. The first is equity finance, usually from the stock market, and then the second type is debt finance. And so here in the Courier, we're looking at the current stock market status of the competing companies in this simulation. There's a couple key features here. So it lists the closing price of the shares, the change over that last competition round in the price, the total value of the company, and then some important information like the total value of the company, that's the market cap, the total value of the equity. The book value is the value of the assets according to the accounting. EPS is earnings per share, so that's the dollars of economic value generated per share owned by a company shareholder. And then the dividend is the dollar value of the dividend paid by the firm, and then the yield is the dividend yield. So, for example, for $2, you could buy for $1 you could buy a share of Chester, and it paid a 75-cent dividend, so that would be a dividend yield of 75%. Whereas an Andrews share would cost you $37 and only give you 65 cents, so it has a yield of just a little under 2%. So the PE ratio is the price earnings ratio. Generally speaking, the higher the stock price, the higher the P, and the higher the earnings, the higher the E. And so price earnings ratio tends to be high when the valuation of a company is large relative to its current earnings. So what would drive a high valuation relative to current earnings? Usually growth prospects. So if the trajectory of the firm looks good and investors believe that earnings will grow, they will be willing to pay a premium to purchase the company shares to reap those expected earnings in the future. Whereas if beliefs about future earnings are poor, then the prices will fall relative to current earnings, and you'll get a lower number. The stock price in and of itself is not particularly important to a manager of a company at any given moment. However, stock sales are a source of financing for the company, and stock repurchases are a source of or a sink for excess cash. And so if the stock is currently trading for low prices, then the company would have to sell more shares, essentially give up a greater ownership interest in the firm in order to raise capital. And so the stock price becomes relevant when managers want to go to the public markets and raise money in a stock offering. So higher prices mean more money raised when shares are sold, and that means preserving more equity for the old shareholders. But it also means less is given to new shareholders. So as the competition rounds continue, the stock price chart will track the trajectory of the value of the company over time. Down below is a bond market summary. So companies in general can raise financing by issuing long-term bonds. So these are $1,000, typically $1,000 loans that are securitized and traded, and they come with a long list of standard legal restrictions on what the company is allowed to do with their money, and also are rated by rating agencies. So here the 6 companies in the simulation have their rating, and just like letter grades, A's are better than B's are better than C's. And moreover, having a triple C is better than having a double C or a single C. So the highest rated company in this bond market currently is Erie with a triple B, and the lowest would be Chester with a single C. And you can see that having an effect on their bond yield. So Chester's bonds with a C rating have a yield as high as 13.5%, while Erie's bonds with a triple B rating have a yield as high as 12.3%. So if you have more debt outstanding relative to the value of the company or relative to the scale of your cash flows, that will decrease the confidence of the market at large in your ability to repay the loan, driving up yields on the company's debt. Now, if they never go back to the market, this isn't going to be relevant, but often companies need to go back and issue public bonds and raise more capital. And the higher the yield investors are demanding on a company's bonds, the less money they'll be able to raise, and the more their financing expenses will be. So the better the credit rating, the cheaper debt financing is as a funding vehicle. So the last significant screen we're going to look at in this video is the statement of cash flows. So this is a really important screen for doing competitive business intelligence. So it, in particular, because it highlights where companies are investing. So for example, if you scan down to the cash flows from investing activities line here, you see that plant improvements can be a sink or source of cash, and that there are significant differences between the teams in their plant expenditures. So for example, Chester has invested $31 million in plant construction and improvements, whereas Ferrous has actually received $15 million from sales of fixed assets. So Ferrous is reducing producing capacity while Chester is increasing capacity. But reducing capacity generates cash as assets are sold. Increasing capacity consumes cash. So naturally then plant improvements, either sales or purchases, require financial forethought. And so if we then scan down to cash flows from finance activities, we can see how some of the teams chose to sponsor their plant improvements. So example, if we use Erie as an example, Erie did $11.5 million in plant improvements, and they sold $11.5 million of common stock. So they funded their entire plant purchase with common stock. Looking at Ferrous, they sold $15 million of capacity and used that money to pay a dividend to the shareholders, to retire some long-term debt, and transition it into short-term debt. So, but strategically, this investments in plant and improvement can predict the behavior of teams going forward. So, for example, we can recognize that Ferrous, having sold some capacity, is perhaps partially exiting a market or reducing their footprint in some of their locations, whereas Chester is planning a significant expansion to one of their products, or perhaps adding a new product. All of those cash flows show up on the balance sheet. So balance sheets are not necessarily super important for doing competitive intelligence, but they have a lot of really useful information for company management within a company. So for example, we can see that Erie has $0 of inventory currently. So that would be, as a manager of Erie, that might be concerning in that it means we have stocked out of all of the products that we sell, and that indicates a failure to properly forecast demand. Chester, on the other hand, has a large $50 million inventory stock, which is going to put a significant drain on their cash reserves and withdraw money annually as those excess inventories are warehoused and serviced. And so looking at trouble spots in the balance sheet is a great way to go looking for ways in which a company can improve their process. Naturally, that is also true of the income statement. Often we troubleshoot income issues using financial ratios like return on sales or return on equity, but they can also sometimes be spotted in the income statement. So, for example, if sales were smaller but variable costs were higher, that would be a poor indication of their variable cost structure. Or if SG&A fees are significantly larger for one company than another, then the team with the high fees should at least recognize that they're spending more relative to other teams and then assess whether they're getting the strategic value out of those expenditures. So those are the financial portions of the Courier in a nutshell. Next, we'll look at the market by market information contained in the industry reports.